Hello, my friends. Today is September 7th, and this is Markets Weekly. So, this past week was a pretty red week in markets. We had notable declines in all major equity market indexes. Now, last week, we were wondering if we would just blast off to new all time highs or if we would double top, and it looks like we have the answer. Today, let's talk about three things. First, we have to talk about the most important data point the past week, the non-farms payrolls print, but let's also talk about a number of other indicators that suggest a weakening US labor market. Secondly, let's talk a little bit about Australia and Canada, two countries that are similar in some key respects. But on the one hand, the Bank of Canada has cut rates for the third time the past week, but the Reserve Bank of Australia has yet to cut rates at all. Let's talk about what might be driving that difference. And lastly, so a few days ago, President Trump floated the idea of a US sovereign wealth fund, and now reports are indicating that Team Biden is running with the idea. Let's talk about why a US sovereign wealth fund is a ridiculous idea. Okay, starting with the labor market. Now, before we get into the really big non-farms payrolls print, let's talk about a number of other surveys on the labor market that together are suggesting that the US labor market is decelerating pretty quickly. First, let's look at JOLTS. JOLTS is basically the number of job openings in the US. Now, we can see during the pandemic era, job openings absolutely surged as companies scrambled to find workers and were increasing wages rapidly to try to entice people to join their company. But over the past year, you can see that the number of job openings has steadily declined, and the most recent JOLTS print was lower than expected. Separately, let's look at the Challenger report. The Challenger is another survey where they ask a whole bunch of companies about their intentions when it comes to hiring and firing workers. One thing that stood out to me in the most recent Challenger survey is this, that the hiring intentions of companies are the lowest it's ever been according to the survey. But at the same time, though, note that whereas firing intentions picked up a bit the past month, they are seasonally where you would expect them to be. One thing that stood out to me, though, is the firing intentions for tech. Now, it looks like there really is a white-collar recession where white-collar workers are having a harder time getting jobs than blue-collar workers, a reverse from the way it's been the past few years. Another popular survey is the S&P's PMI index, where they survey a whole bunch of companies when it comes to, say, their judgment on business conditions, hiring, and so forth. Now, the most recent services PMI shows that services companies in the US continue to expand. Now, that is, of course, in line with what we saw in the GDP data, where the most recent second quarter GDP was revised upwards from 2.8% to 3%. Companies continue to expand. However, though, in the most recent PMI survey, they also note that the hiring component is the weakest it's been in 3 months. Now, the last survey that I want to look at is the Fed's Beige Book. Now, the Fed actually has a very, very extensive intelligence gathering operation where they talk with businesses big and small throughout the country to kind of get a sense qualitatively what the businesses are doing. Now, according to the latest Beige Book survey, companies are not really firing anyone, but they're also not really hiring anyone. And they continue to, view business conditions as pretty uncertain, so they're not really sure what they should be doing. Now, taking all this data into account, it's painting a picture that whereas we don't have a lot of companies firing people, and again, that's consistent with the weekly job unemployment claims not really spiking, but also they're not really hiring a lot of people. So they are moderating their plans, but continuing to expand. That brings us to the most recent non-farms payrolls print. Now, the headline print was a bit softer than expected, but still showed over 100,000 jobs created last month. What stood out to me looking into the details was the unemployment rate declined from 4.3% to 4.2%, which is really good news because oftentimes when we see an increase in the unemployment rate, it tends to continue to increase and sometimes rapidly. Now, again, the labor market, to be clear, is slowing but not yet sending recessionary signals. When we have a recession, we don't create 100,000 jobs a month, we lose 100,000 jobs a month. And we see GDP contract rather than expand at a 3.0% annual rate. But we are heading into a direction where it is possible in the coming months we could slow enough to tip into recession. Now, the equity market seems to be looking at all this labor market data and becoming increasingly concerned of a potential recession, in which case equity prices usually go down, sometimes by a lot. The interest rate markets are looking at this and pricing in pretty significant Fed cuts. We had important Fed speakers on Friday, and they seem to be open to the idea of larger than expected cuts, but not right away. And so the market right now is pricing in a 25 basis point cut in September and probably larger cuts in November or December. And that could happen depending on how the data evolves. At the moment, though, I think it really is just whatever the data brings. So let's watch that closely in the coming weeks. Okay, the next thing that I want to talk about is Australia and Canada, two countries that are similar in many respects, but have had very different monetary policies. So how are they similar? Well, first off, again, they are English-speaking countries that are, share a Anglo heritage like the US, and they are similar in size, with Canada being a bit bigger. Now, some of their policies, though, are also very similar. So both countries have had tremendous amounts of migration the past few years, notably from India, where in 1 year their population increased by almost 3%, almost entirely from migration, both in Canada and in Australia. And these countries are, again, heavy in resource extraction and also home to tremendous surges in home prices. And like the rest of the world, they also experienced high inflation. So we've talked about Canada before. Over the past few years, we saw CPI in Canada surge, but over the past year also come down significantly. And so much so that the Bank of Canada cut rates for the third time last week. No surprise, looking at their inflation numbers, they're very close to 2%, and they've also been seeing notable rises in their unemployment rate. Now, overall, Canadian GDP continues to grow, but that is often masking a per capita recession where the GDP is merely growing because you're adding more people. On a per capita basis, GDP in Canada has been shrinking for a few quarters, and so many people are feeling squeezed. But thankfully, though, the rate cuts are helping a lot of people because a lot of mortgages in Canada are renewed every few years. In a sense, it's kind of like having a floating rate mortgage. And as interest rates go down, more and more Canadian families are able to renew their mortgages at levels that or lower than, let's say, the 5 and 6% they would be at not too long ago. Now, moving to Australia, even though there are similar macro factors, the Reserve Bank of Australia actually hasn't cut rates at all. In fact, not too long ago, there were whispers of further rate hikes. Now, looking into the inflation data in Australia, it's clear that the Reserve Bank of Australia is not cutting because inflation remains high at 3.9%, again, much higher than their inflation target. Looking into the components of inflation, similar to Canada, a big part of their inflation is driven by rents, where when you increase the population significantly, of course, that creates tremendous demand for housing and all sorts of other services like hospitals, education, and so that also drives up services inflation. So in a sense, similar to Canada, their inflation is largely the result of their macroeconomic immigration policies. Now, strangely though, why has the inflation come down so quickly in Canada, but not as quickly in Australia? Now, one reason for this that's being floated around is that the interest rates in Australia actually did not increase as aggressively as they did in Canada. Looking at the policy rates for the two countries, you can see that the Bank of Canada raised rates super aggressively and has begun cutting them, whereas the Reserve Bank of Australia didn't hike rates as much and just kind of kept it there. And it's possible that they did not raise rates high enough. Another possibility is that Canada being much closer to the US, again, tremendous amounts of supply chains and so forth, maybe it's just easier to get the side down. But I think it's pretty interesting to see how these two countries have similar in many respects, but such different pathways when it comes to monetary policy. And right now, the market is thinking that maybe the RBA would cut later on, but obviously, when inflation is at 3.9%, you probably shouldn't be doing that. Okay, the last thing that I want to talk about is the idea of a US sovereign wealth fund. Now, this idea has been floating around by President Trump a few days ago, and now there's a Bloomberg article suggesting that there are influential people in the Biden administration who are actually trying to put this together. Now, this is a really strange idea because, well, first let's think about why countries usually have sovereign wealth funds. Let's look at, for example, Norway, which has a tremendous sovereign wealth fund of more than $1.5 trillion. Now, why does Norway have a sovereign wealth fund? Well, the country owns a whole bunch of oil, and the government sells that oil and it earns a whole bunch of money. And what do they do with that money? Well, they decide to just put it in this sovereign wealth fund that in turn invests in stuff throughout the world with the notion that, eventually one day this oil is going to run out, or maybe we transition into an economy that requires less oil. So right now we have this windfall. Let's be responsible and invest this money so that future generations of Norwegians can benefit from it. So this ginormous sovereign wealth fund of Norway, what do they do with it? What do they invest in? Well, actually, if you look at their largest holdings, again, they hold equities, fixed income, real estate, clean energy stuff. Looking at their equity holdings, their largest holdings. Now, to get, this is in Norwegian krona, to get that into dollars, divide by 10 point something, 10, 11. So basically, the largest holdings are basically Mag 7 stocks. So, and to be clear, they've done very well with Mag 7 holdings. So the Norwegian sovereign wealth fund has a bunch of oil money, buys a bunch of US stocks, buys a bunch of US treasuries as well, and real estate throughout the world. But it makes sense. Obviously, they have a lot of extra money. Now, another common way that people have a sovereign wealth fund is that their country earns a lot of money through trade. Now, let's look at the case of China. As we all know, China is the workshop of the world. Chinese businesses are very good at manufacturing things, and they sell to countries throughout the world, and they earn more in foreign currency than they import. So they export more than they import, and so they have all this foreign money, largely dollars, left over. So what do they do with all this foreign currency? Well, the Chinese government invests it. Now, a lot of it is in things like treasuries, kind of safe assets, but we also know that the Chinese government has been investing this throughout projects throughout the world, say in Africa, through things like the Belt and Road Initiative, in part to build political goodwill, but also in part to diversify their exposure to the US government. So they have a lot of extra money that they earn through trade, and then they go and they invest that elsewhere. Now, let's look at the US. Does the US have tremendous amounts of natural resources? Absolutely, except that it does not belong to the US government, or at least the US government is not exploiting it. So there's no huge oil fund, oil revenues that the US government has. What about, does the US earn a whole bunch of foreign currency from their overseas exports? Actually, it doesn't. The US is famous for having a current account deficit, so every year they import a lot more than they export. So that's money flowing out of the country to the tune of hundreds of billions. So obviously the US government does not have excess money to invest. So where would the money for a sovereign wealth fund come from? Well, it would probably come from the same place all US government spending comes from. They would just print a bunch of treasuries and use that to finance the sovereign wealth fund. Now, reporting from Team Biden suggests that the rationale for having a sovereign wealth fund is to invest in strategic things, be it resources or cutting-edge technology, and basically help in the geopolitical great power competition. Now, that's kind of strange to me because it seems like the US government is already doing that, right? Every year, the US has a tremendous fiscal deficit. A lot of that goes into things like defense and subsidies to all sorts of industrial projects. So, in a sense, the US is already spending a lot of money achieving those very same goals. The Defense Department obviously invests in all sorts of private sector companies to try to get technology and so forth. Now, how is having a sovereign wealth fund different from, let's say, just what we're doing right now, appropriating money through Congress? And I think the key difference, again, remember the US doesn't actually have extra money to invest. It would be just another way to have more government spending, except outside of the purview of Congress. Right now, if you have a company or if you are a special interest and you want to get money, you have to go and lobby your congressman, and maybe Congress passes legislation and basically prints treasuries to finance your handout. If we were to have a sovereign wealth fund, now going forward, now special interests or whatever companies that want to have government money, maybe they won't have to go through Congress. Maybe they can go through whoever is governing the sovereign wealth fund instead. In a sense, it would give the executive, or however the sovereign wealth fund is governed, access to a piggy bank that they can then dole out to their friends, or maybe even to things that they think are important. So it seems like a U.S. sovereign wealth fund doesn't make sense unless you want to have more government spending outside of the purview of Congress, basically without checks and balances. So to me, that seems like a bad idea and a way to circumvent our political system. So hopefully there will not be any sovereign wealth fund. And to be clear, the US does not need one. If you have the reserve currency, whenever you need to buy something, you do it the way that the government already does. You just print treasuries. All right, so that's all I've prepared. Thanks so much for tuning in. If you liked the video, remember to like and subscribe. And of course, if you're interested in hearing my thoughts, check out my blog at fedguy.com or learn more about macro markets on my online courses at centralbanking101.com. Talk to you guys next week.